Welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats that we do with top traders, and we've got Keith Harwood here with us today, hot off a red hot pick from the article last week. JP Morgan, man, this was, you could take that straight to the bank, pun
Yeah,
intended.
yeah, no, that one worked out pretty well. Obviously, JP Morgan did exactly what the model was predicting. So, the AI didn't steer us wrong in this case. And, those July 11 280 calls are up about 100% in a week. So I don't think anybody's too disappointed in that to start this one here. And, with the market breaking out now, it looks like there's going to be some other opportunities on the bull side. So, really good opportunity, I think, right now for AI-driven models to really help now that the fundamentals seem to be a little bit more behind us. I mean, we do have non-farm
Yeah,
payrolls, but less
yeah, those,
worry about how things go in Israel and Iran, or how things are going to go with trade negotiations, or they were still working on the big beautiful bill, but making progress there, and all of a sudden we're lacking fundamental inputs. So
right. Yeah, no, there are a lot of dials being turned all at the same time on this market.
mhm.
And you know, we're at a critical technical point. New highs are always just such a huge factor in so many different people's trading strategies, algorithms, all that stuff. So we get into this place where all of a sudden, I kind of feel like we're floating a little bit, and you don't know exactly. Everybody thinks, oh, well, I would say the majority of the headlines that I'm reading, let me just reference this with the source that I'm getting it from, uh, thinks that we're still going to be, it's going to be bullish, that we're going to continue to see things rise. We're seeing some technical indicators that support that. But what we've learned over the last few months is this is a somewhat unpredictable market. It
Yeah.
started out in the early spring. It started reacting to every headline that came out, and we were whipsawed and tossed around like a rag doll. And now, I mean, I look back to what happened in Iran, and the market just basically just pushed snooze right through the whole thing, and
Hmm.
really didn't move at all. So now you got headlines, where people are the market's being desensitized to these headlines. So to your point, you're looking for the key indicators, the fundamental stuff to see if that is what the market is dialing into. We got to get a sense of what the general, when we say the market, it's all the traders, obviously driven a lot by big fund managers. They're what move the indexes a lot. They move a lot of the big stocks a lot. What their thought is on what's going to happen next, and see how that plays out. And fortunately, we've got you here today, both with the incredible depth of experience from, being one of those big guys out there trying to move the needle on the market pretty much. And coupled with the tools that you guys have built that help
Yeah.
do the heavy lifting, scan for all these opportunities and find the needles in the haystack. So, way to go on the JPM. Thank you so
Yeah.
much for sharing that with everybody. Hope some folks in the audience were able to take care of it. If you're in the room now, definitely jump in the chat, shoot us questions. We want to have you involved in this. It's not just Keith and I here talking. We want you to be part of it. So just go in the chat and shoot us a question if you have any questions. But all right, Keith. So JP Morgan did great. Now what? What are we looking at today?
Yeah, let me go ahead and share screen here. We'll do a quick review on JP Morgan and then get into the next element of it. So, uh, go. All right.
Sorry about
So,
that.
just to start off, let's see if that loaded. That looks like it loaded up okay. So with
Yeah, there
JP
you go.
Morgan, last week we were starting into this bullish setup. By Tuesday, Wednesday, just kept pushing higher. Great little setup overall with that breakout and then confirmation. Obviously, it helps that the whole market was rallying. So S&Ps, when we've reduced some of those fundamental bear inputs, now the bear needs to look for something new to grasp onto, and the bear is finding a tough time finding anything to grasp onto. Israel and Iran could have been it, and then it wasn't. It was real quick. And the bear got used to this idea that everything that was happening with US and China took a long time, and it started getting this big payout for them. These little bits of somewhat bearish information that then get resolved within a couple of weeks, that's not feeding the bear. And there's that old adage, you have to feed the bear in order to get the bear to continue to play off. The bear that stayed engaged throughout that whole US-China trade situation certainly got paid depending upon when they exited. They may have felt some pain here if they got engaged late and then had to bail out on April 9th. And at the long haul, the bear didn't get paid if they held on the entire, 5 months that was going on. So what does that mean for the market? Is it starts to put some more confidence in the bull that, we can weather these storms and, oh, I can buy the dip. And even if it goes lower, as long as I have some cash, I can buy more. But then when we get to a new high, waiting for a dip no longer feels right psychologically. People start to say to themselves, oh my God, maybe I missed this move. Maybe I missed this opportunity. And then they start to deploy that cash. Algorithms start to say, we got above a new high. The previous high on February 19th was 613.23. We're now $4.50 higher than that. So people start to get this sense that over the long haul, buying works. And if I'm not in right now, I missed the boat and I got to get in and I got to figure out a way to get in. So they start buying even more. And for me right now, this broad market just says, as long as we stay above 613.23, the bull is firmly in control. If this ends up being a false breakout, we drop below 613.23 and we're back in a chop trade with 613.23 as resistance, the high point that we'll struggle to get above. Maybe yesterday's high if we pull back starting today. But right now, there's not a lot to get in the way of this market to stop it from just drifting higher. Money flow is generally positive for the market. There's generally positive upside for the market. And the VIX right now is actually getting very low, but not as low as it could get. So I'll note that the VIX could certainly get lower. It's at about 17% now, a little bit higher yesterday. The lows of the last 6 months are around 14.5%, 15%. We do have earnings coming up. That whole cycle resumes in about 2 weeks. And when that resumes, that creates a little bit of volatility for the market. And it'll be interesting to see how the market decides to react to earnings, because maybe over the last 3 months, there were some impacts from tariffs. So I have a feeling that more than anything, the earnings reaction for the market is going to be driven on forecasts for the future, for the rest of the year, for going forward, now that the tariff stuff has been kind of resolved to a great extent. People now know what to do and how to plan for it. So you look at earnings projections for the rest of the year.
With the tariff stuff, I see a pattern where people are accepting that this is a process to get to some long-term strategy, that this churn, this back and forth, these absolute, we're never going to do that. All right, now maybe we actually are going to do that. It's just becoming part of the process, and that's getting priced in. All those things are starting to get priced in, so they're not as impactful as they were a couple months ago. But it's this desensitization that now we have to factor in, and we have to understand that's what's going on. So sorry, didn't mean to interrupt.
No, absolutely. I mean, to your point, it's the art of the deal, whatever. Whether you like the way that the negotiations are going or not, or how they're being managed, it is all in effect. The goal is to get a deal, not to have massive tariffs both ways and then just leave it at that. The goal is to go to the extreme and then pare it back to something that's reasonable for both US and China, or for both US and Canada, or for both, US and Mexico, or whichever partner you're looking at from a trade perspective. It seems like the end result is, though, the approach that we're taking, or that, President Trump has been taking, is say, here's an extreme version. If you react, we'll make it even more extreme. But if you come to the table, we'll pare it back. We'll get to something reasonable that everybody's happy with, and that includes the market. And it seems like right now, like you said, the market is now understanding that, okay, we're not going to the extreme. We're not leaving it there. This is all part of the negotiation, and it may be somewhat frustrating at times to read through. For many, and for the market bull, it was certainly frustrating in March and April, but now there's confidence that things get done. It all ends up working out. It just might have a little bit more short-term volatility in the negotiation process. But now, if that negotiation process is broadly complete and we're beyond the extreme reaction type stuff, what's that next input that's going to get the bear worried. Is it going to be some sort of inflationary input? Doesn't seem like that's rearing its ugly head. So the Fed can continue to look to cut rates as they were projecting for this year. Is it going to be an employment data number like non-farm payrolls on Friday? Maybe. But overall, right now, the bull is firmly in control. And so looking for some long market exposure just seems natural. And, for me, the biggest thing is defining that risk by saying, if we get back below 613.23, then for the short term, we can go back to a chop, and then I got to look at different strategies for it. Over the long haul, it seems like the market on an investment perspective is to the upside. But we're looking for those short-term opportunities more than anything, just to kind of time out some moves with this AI generated system. So, my focus is really on that big 613.23 level in SPY, stay above there, and the bull's in control for short-term opportunities.
So it all tracks, it all lines up.
Yeah.
I think I'm right there with you. What does that mean for us as a trader trying to pull some income out of this market now? Where do we start to look for the type of
Yeah.
trades that can pay the bills,
Absolutely. So where I go from here is I go back to that forecast toolbox. I just really have found so much success with this, and so it's a really powerful tool. First off, I start with the broad market, SPY. We know it's at a new high. The technicals say bullish, and the AI says just drifting higher. A really nice positive trend here. Right now, projecting as much as 4% over the next 4 weeks or 2 weeks. Now that may seem a bit out there, but if I only look out about a week, 1.5% over the next week in a potentially slow period, as long as non-farm payrolls comes in okay, it seems like a natural drift higher, 1.5%. That would be well within the normal style of movement. And so we've got a tailwind for this broad market. Before I jump to a new idea, I do want to note that JP Morgan is still projecting a very nice bullish trend. My biggest concern with this is that if non-farm payrolls does come in surprisingly, it may shift financials. So I don't know that I want to hold through Thursday morning. So today, Tuesday, tomorrow, Wednesday, looking towards the exit. Does still show a positive vector, still high confidence in that. So, depending upon how anybody wants to manage a position on that, they could look at any exit time. I'd be looking sometime midday on Wednesday as a exit point, barring a market pullback. But to find a new idea, I just went over to the company screener here, checked out some short-term forecasts, and I look through all these, and I got a lot of positive ones. NOV is saying negative after being a positive one that we were looking at a couple weeks ago, thanks to oil dropping. But rather than focusing on, say, oil companies or some of the financials like Bank of America or XLF, which do show positive signs, I went here and said, interesting, News Corp is on the list. So when I pull up News Corp, it seems like it should be a little bit immune to some of the other economic data. Model grade A, that's a really good sign. That's our best grade. It means that 75% of the time, these stocks fall within the projected range. So that projected high and low, 75% of the time, we would expect it to stay within 34.13 to 34.74 for the upcoming trading day, Tuesday. And looking at that long term, it looks a lot like JP Morgan's chart did last week. Just general positive trend, expectation of 9% over the next 2 weeks. And to be clear, News Corp is a very low volatility stock relative to a lot of these others. So when you can get something like this in a stock that is normally moving roughly the same percentage as the S&P 500, this is where that leverage really can potentially kick in. Remember, 1.5% for the S&P versus 5.5% for a week in News Corp. And it may not seem like a lot, but News Corp right now at 34.30 with a projection for next week of being around 36. I can go to the options market again. I know I've got earnings on August 7th, so a little bit questionable there, but I can get the 35 calls for 30 cents. So this is another one. This is more of a real home run potential hit, but if we can get to 36, these are worth at least $1.
Which
If we go to
expiration date were you
36
looking
and what's that?
Which expiration date were you looking at for the?
Staying a little bit short term here, so I'm not paying the earnings premium. The July 18, 35 calls are trading 30 cents. So I wouldn't size up huge on this because that does require a bit of a rally, but they're only 30 cents and a market rally of $1 in NWS. These are now fully just into that profit zone. Rally to 36. You should be trading a buck, buck and a quarter. If we get that full move, these could be trading two. Through expiration or right to it. This is projecting out to $37. These would be trading $2 minimum at that point. And that's a huge
That's
potential
huge.
return. Yeah. So I'm
Right,
thinking,
right.
just for the week at least, I can look at this for a potential for a triple or maybe even a quadruple, similar to what I was looking at for JP Morgan last week. But actually happening in potentially as little as a week, where JP Morgan looked like it needed 2 full weeks to get that kind of return. So
Hmm.
NWS being a low volatility stock with a high projected move, this looks like a really interesting setup. And for those that are a little concerned about things like, market volume and stuff, yeah, NWS does not have a lot of volume. I believe it's actually NWSA that gives a little bit more volume, and that could be the alternative play here. They're related. It's News Corp versus the B shares. You get a little bit extra. I switched them around here, but NWSA is going to have the same projection because it's like GOOGL versus GOOG. You get a tighter market here. NWSA is probably actually the better play in that scenario, but it's trading 29.72 versus NWS is trading 34.31. And when I pull up NWSA here, just to give that a little bit better clarity, it's got a very similar expectation on the upside. The model kind of a little bit funkier with it for whatever reason, but it's still got an A model with a week out move of about 4%. $31 in this stock, similar kind of setup where we're looking for the 30-cent option here to go to about a buck. NWSA has about a 40-cent option going to about a buck. So very similar overall. Either one of them looks like it could work pretty well. But I think that that's an interesting sector to move into that's not as subject to, say, non-farm payrolls information, and may kind of fall under the radar for a lot of investors in spite of a broadly bullish looking stock chart and approaching the previous highs around 30.70 for NWSA. It was 30.69. So just testing that, that's already a double if we get the full move, looking at a triple or a quadruple in a name like this.
Now that's and it wouldn't even dawned on me to even look at that. I
Yeah.
haven't seen it on any of the scans that I've got, but I mean, I don't have near the capability that you guys have behind your analyzer there. And that's what makes this so helpful is to find the stuff that you just wouldn't see. That as a regular trader, you're kind of scanning through tickers. You might have a couple tools. Which tool do you really have faith in? You're always trying to validate everything, and to have somebody do all that for you is just such a huge help. I mean, that really
Yeah.
makes life so much easier from like I said earlier, the person trying to generate a little income out of this and pay some bills.
Well, and to your note, I mean, NWS is not a stock I've looked at in months. I mean, it's not a chart that I normally pull up. I mean, I'll pull up Western Digital, I'll pull up Win, I'll pull up Bank of America, XLF, of course. NOV recently we were looking at because of the oil stuff, and I will occasionally look at like Dow Chemical, but there's a number of names here that would never even fall on my radar at all. And so grabbing that, having that ability to then look at it and say, well, maybe I'm interested in Western Digital. And I see, Western Digital also has an A grade and a very bullish looking trend.
Yeah.
Maybe that's a better trade for me. And I can play throughout this every day because this screener gives me anywhere between 5 and 15 ideas that have a high model grade with a projection for some either bullish or bearish behavior. And sometimes they're just
Hmm.
bullish for a day on here, and that's not interesting to me. But those
Yeah.
ones that look really exciting for a week or two, that's where I have that potential for the money flow in my favor, and the model is showing that it is getting into a bullish setup. And I like News Corp because it's really not one that I normally look at. And if the model's pulling it up, it kind of attracts me to say, well, what's it seeing? What are we looking at here? And how can I trade something and make some money off of something that may be less correlated to the names that I'm normally looking at, focuses on big tech or financials.
Right. Yeah, and that's it too. I mean, you've got to understand what's going on behind the scenes, and there's a lot of information into the tools that you guys provide to say
Hmm.
this is kind of what it's doing. This is what's going on. This is, you can easily get overwhelmed with the kind of tidal wave of AI kind of taking hold of everything and all these
Yeah.
algorithms and everything else. You know, this is one of the applications where it can just consume, process, and distill so much information at such a rapid pace. This is the ideal application of that kind of capability.
Yeah.
And so then what happens is now, if we're doing this even just a couple of years ago, you'd be pulling up chart after chart after chart. Even if you have a scanner and you can set some parameters, you're still thumbing through charts, looking at it, and you don't have the kind of background. You don't have it doing, checking how many thousands or hundreds of thousands of data points on each ticker to not only check where it's at now, but the probability of where it's going to go. Just phenomenal. Just really
Yeah.
great to see an application of this that makes sense and can really be beneficial to the average person. That's the big part.
Absolutely. It's getting a power tool instead of using a hammer or a screwdriver. And
Yep,
knowing how to use it is a very important element of it, of course, because you can be dangerous with a
absolutely.
power tool. But you can be dangerous with a hammer or a screwdriver too, I suppose. If you don't know what you're doing, you hit the wrong spot or you miss the
Yeah,
nail and you get your thumb. But if you
been there,
can
done
have
that.
that
Yep.
access to something that can make you more efficient and more profitable and greater confidence with that extra due diligence layer, I think it's a really valuable tool, and I've seen it be very valuable to finding ideas for myself here as well.
Yeah, no, this is awesome. Well, Keith, man, I appreciate you taking the time, walking us through, letting us get a glimpse of what the tool's showing us. The tool's available, folks. It's out there. We'll put the link in the email for you if you want to check it out. I know that they've got a pretty good offer to give it a test drive and kick the tires
Yeah.
on it. So take them up on that offer. And this is definitely something that we've seen work repeatedly on our eye openers. This is not something that, oh, we just stumbled across it today
Mhm.
on here, and it's done a great job of spotting trades. And the people who are tuned into these sessions, they're seeing stuff from Keith that is just really reliable and actionable. So, Keith, thanks again for your time and for, like I said, showing us what this thing is capable of. Really appreciate that.
Absolutely. Thanks again, John.
All right, everybody, take care, and let's have a great holiday if we don't catch you
Yeah.
guys before the holiday, and we'll be back again next week with some more sessions. Take care.